The RBA's first interest rate meeting of the year is a few weeks away, and economists have a mixed view on what to expect. In the meantime, we have an inflation reading next Wednesday, as well as the all-important December retail sales data coming shortly after that. The Bank of Queensland's forecasting the RBA cash rate to reach a peak of 3.6% by June. And for more, I'm joined by BOQ's Chief Economist and Head of Market Strategy, Peter Munckton. Peter, thanks for joining us today. Let's start, though, with the unemployment numbers that came out this week. Do you think the jobs market's starting to slow down?
Thanks for having me, Ed. Is it slowing down? Well, the answer is shortly yes, in some respects. Mid-year, demand for labour was white hot. You just had a look at the number of ads in newspapers, online and so forth. Just a humongous number, right? And as we've gone through this year, there's been some slowing in that demand. Sort of some of the sectors immediately hit by the higher interest rates. They're asking for a few less people, investment bankers. They've made a few headlines very recently. We've had to import a whole lot of stuff to fill up stores, right? We've filled up the stores a fair bit, so we need a few less people doing that sort of thing. And of course, we're not taking as many PCR tests as we did this time last year. So that demand for labour isn't quite as strong as we saw through mid-year. So the first bit is there's a little slower demand for labour than what we had mid-year, but it's still really strong. I mean, really strong. Pre-GFC, everyone was talking about the mining boom and what the demand for workers was. Right now, our demand for workers is stronger than that.
Yeah, the stock market really jumped on Thursday after the numbers came out because it looks like investors now see that as a sign that the Reserve Bank may not need to lift interest rates as aggressively. What's your reading into that?
Look, I think that's absolutely right. The biggest fear that markets investors had for this year, stock market investors, was the central banks would just keep raising rates and keep raising rates and keep raising rates until the economy pip started to squeak, right? So that was the biggest concern. And two things have sort of happened over the last couple of months. First of all, there are clearer signs that inflation, not only globally but also Australia, looks to have peaked. So that's the first bit. That's the first bit of good news. And the second bit of news is sort of what we just touched on, that the economy is showing more signs of slowing. And so if we go back a few months, financial markets were pricing a peak of the cash rate of 4.5%. Now, there were genuine concerns at that point in time if cash rates went to 4.5% in Australia and obviously higher numbers overseas, that would create really big problems for the economy. And then after the sort of data we've just been speaking about, right now, financial markets are pricing a peak in the cash rate of around about that 3.6% mark. We're still not 100% certain what that means for the economy, but what we can be more certain is the economy is going to be in better shape with a 3.6% cash rate than a 4.5% cash rate.
Definitely. And look, you just mentioned inflation and we get the December quarter inflation figures next week. So you think we'll see the peak of inflation in that quarter in Australia?
Well, I think what we've been seeing since even early mid-year, if you look through the monthly and quarterly numbers, those percent changes month on month, quarter on quarter, we've been looking through those sorts of things. In actual fact, it peaked around about that time, about middle of the year, because remember what happened back then. The economy opened up, there was no goods anywhere, so all of a sudden prices were high. So that was high. Then we had the weather, couldn't get stuff on the shelves because of food and so forth, the weather problems. And then Russia-Ukraine hit, right? That meant issues for food prices and energy and so forth. So at that point in time, the price hikes were really quite high. And so that was it. Then what's happened over the course of this year is those monthly, quarterly price changes have broadly been about the same, but they haven't gone any further. So essentially on a month by month, quarter by quarter, we were sort of been peaking. It was a long peak, what we've had seen this year. And I think what we'll get through next year, Ed, is that slowly we'll start to see those inflation numbers come down. And we already start to see some positive signs. We're no longer paying as much for petrol as we were. There's some positive signs in the shops. There's been stories going around that used car prices are starting to go down.
Finally
so there's some positive things out there. And I think we'll get some of those more positive signs as we go through this year. The key question, though, Ed, is we believe, we are forecasting inflation to decline this year. The key question for interest rate markets is, how quick will that decline actually be?
The other data we get is the retail sales for December. That comes out, I think, on the 31st of January. And Aussies have been setting records each month throughout last year. When is the consumer going to start tightening up that spending and start to feel the impact of those 8 rate rises that the RBA put through the economy last year?
So I think there's been some tightening up. They're no longer going quite as hard in the shops as they were sort of mid last year. I think we're starting to see it. Even if you look at, go to Google, type in restaurant near me, the proportion of people doing that is starting to decline over the last few weeks. So I think we're starting to see some signs of slowing on the consumer spending front. The consumers are still spending. And that's the thing as we ended this year, that we ended last year in a pretty good state. We're starting this year with consumers not spending much, perhaps quite as much as they did last year, but that growth is still there. And why is that? For a lot of people, they built up a lot of saving. Wages growth is rising, and we know, despite our discussion slightly early on about what's happening in the jobs market, the jobs market is still really strong. 50-year lows in the unemployment rate are still there. So people still have money to spend. They're spending it, but I think we'll see that spending growth moderate as we go through 2023.
Well, Peter Munckton from VOQ, thanks for your time today.